Chapter 11. The Statement of Cash Flows. Cash is the most important element of any business in my opinion. Without cash, you don't have a business. As we learned in the previous chapters, many of the journal entries involved cash. We even did a bank reconciliation to reconcile cash. In my experience, all of my vendors prefer to be paid with cash. I prefer to be paid with cash. Chapter 11 takes all of the accrual rules we learned in chapters 2 through 10 and sets them aside to get back to cash basis. Why? Because the statement of cash flows provides vital information regarding what happened to cash, hence the name cash flow. This is the statement where nothing is hidden. If a dollar came in or went out the door, it is on this statement. Managing cash flow is a very important job within a business. When I was finishing college, about to sit for the CPA exam, I interviewed with a drug research company. In talking to the controller, he said his biggest challenge was managing cash on a daily basis. I asked why that was. He said, first of all, there's not enough of it. Second of all, if he could keep his company afloat for one more year, month, week, day, the scientists have that much more time to find a cure. My brief interaction with him changed the way I viewed accounting and my role to this day. Chapter 11 tip is this right here. It's a chart I developed to help me learn how to do a statement of cash flows. It's a little cumbersome at first, but it all works the same, and once you get the hang of it, it really streamlines your process. Here's how it works. We'll start with the indirect method down here. In the indirect method, you want to identify if the account is an asset or a liability. Calculate if the account increased or decreased. Locate the account type, asset or liability, and then locate the increase or decrease box below the account type. Increase, decrease, increase, decrease. And then you want to go to the next line with the minus or plus sign. Remember, we're on the indirect line. And determine whether or not you subtract the amount from net income. So let's give you an example. Assume accounts receivable decrease. Accounts receivable is an asset, and it decreased. Therefore, according to the chart, you would add the decrease to net income. Assume accounts payable decreased. Since accounts payable is a liability and it decreased, according to the chart, you would subtract the decrease from net income. The direct method works the same way, only the accounts start with either revenue or expense. For example, if you're trying to solve cash received from customers, which is net sales plus or minus the decrease or increase in accounts receivable. So let's assume accounts receivable decreased. Since accounts receivable is an asset and it decreased, your starting account was a revenue, net sales. According to the chart, you would add the decrease to net sales to equal cash received from customers. At first try it's confusing, but after a few times, like I said, you'll get the hang of it. And I think you'll enjoy it and it will help you immensely. See you on the other side.